Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. This week, my guest is Adam Ras. Adam, if you want to give everybody a bit of an intro to yourself, and then we'll jump into this.
Thanks for having me on the show, and hopefully you can add value to your listeners. I'm a multifamily and syndicator. I started basically 8 years back, and my background is in electrical engineering, was 15 years so far.
Yeah.
And my main focus was development project and dealing with municipalities and Ministry of Transportation. And because of my focus on transportation and all of that, I realized the potential of the power of the real estate and investing on it. So I started on the beginning on investing on Blackstone. And this is basically the passive investing trend in US.
Yep.
I liked the portfolios, the return was great. And then I told myself, why not starting by myself on a small multifamily? So I started on Canada, in Ontario, as a starting point for all of investors, I think, from Canada, in investing in duplexes and triplex between Hamilton, Oshawa, and Guelph. And then I realized this is not working for me. This is not enough because the scaling is not enough. So in 2019, I had my first relevant syndication relevant to US size in Manitoba. And then for some reason, again, I didn't like the Canadian market returns. The syndication is not known enough in Canada. So I started to work with, again, passive investing on 2020 on US and Atlanta and some of the Midwest states. And my first deal on syndication was 2021, 100 plus project. And this was basically it. Basically, it's a starting point for me was Blackstone.
Yep. So I already have a couple questions for you. So you started off with a bunch of like smaller multis in Canada, Burlington, Hamilton sort of area, I believe. You keep that stuff, or did you unload it?
So far, I keep all of my properties. I didn't sell anything.
Cool. And then now you're talking about you built your own syndication and did a syndication in 2021. And I know you're looking at doing more of these. What has changed in the market? Like, is it the same buying criteria? What's it looking like different from 2021 to 2023, where we're at now?
So basically, what's happened on the last 5 or 6 years was like we were on the top of the market. Everyone has ability to make money. And now the situation now is similar to what happened in the 80s and the 90s recession. And the current market now, we started only the recession, I think, a couple of months. We're not on the bottom yet. No one can have a crystal ball about when we're going to hit the bottom.
Yep.
On the US and the US in general, we're waiting for the first raise on this year by the Feds on February 1st. The second one will be, I believe, in 21st of March.
Yep.
So based on the expectation, we see that the market is going to have another 25 base point on February and March. But still, we don't know what's going to happen. And this is really going to formalize the market, in my opinion. And I think 2023 is going to have a lot of opportunities for all of the active syndicators for really particular reason, because what happened on the top of the market in 19 and 20, all of the syndicators trying to make money. And because of that, they tried to have a bridge loans and mezzanine loans and interest-only loans to make more profit and promise their passive investors with more income. But the problem was that now that they hitting the roof, the interest rate with the flexible or variable rate, it hit the roof, and potentially they're not gonna be able to hold their property. So I see that 2023 is gonna have a little bit a different market than 2022. But yet, are we in the bottom of the market? I don't believe. This is gonna be, I think, more shown on the next 3-4 months.
Oh, definitely, yeah. Because even still, there's still market indicators that are driving this to say that they should be raising the interest rates if they're trying to get the inflation down to certain levels. But even still, once that even stops, the market, they stop doing the interest rate hikes. It's still going to take some time for people to adjust, right? People, that's not usually good enough. People, I don't know what the term for it is, are a little sheepish. They're gonna wait until other people are doing it, until things are starting to go a little bit better, right? Until they see the results instead of just seeing the indicators, right?
I think the issue about that so far as inflation is still high. We're talking about 6.8% based on November status. And I don't see the Feds are going to stop until it comes to the regular percentage of 2.5. And this is basically what happened, especially on the 90s, which can drag the whole real estate business to 2.5 to 1.5 year recession, which we don't want to have it in the US market. But this is the reality about what's going to happen on the market, I think, on the next between 9 to 18 months from now. And this is basically what's driving even the prices down. So you can see an actual rise on the cap rate on all of properties on different states. So our focus as a company, we're focused on the Midwest, especially Ohio, Michigan, and our main market is Missouri. We see that the cap rate has been we have an advancement on the cap rate, and this is because of the interest rate, and this is basically what we need on the upcoming months, because we can for now we can say it's a buyer market, but not yet, because the seller expectation is still high, and it's gonna come to point that both ends have to come to realization about the price.
Yeah. And I don't know, maybe I'll ask this as a question instead of stating what I was thinking, but cap rates, as cap rates are rising, what's that do to the price of the property?
It's going down.
Exactly. So yes. And then on top of the value of the property is going down, the interest rates are going up. Yes. So what you're saying is that people are getting themselves into a pinch. Some of these people who were a little over-promising on some of these syndications that they've built. So there should be coming up an opportunity, right, in order to pick up these things at a good price, right? I don't know if you know this side of it, but what are the banks doing? Are they panicking with this situation, or are they looking to offload these to other investors? What's their side of this?
So as I mentioned to you, the opportunity coming from whatever happened on 2019 and 2020 was where we went on the top of the market. What's going to happen is potentially is not for all of these indicators, they're not going to have enough cash flow on their properties. Is not going to able to meet with their passive investor cash flow monthly, and potentially they're going to have to rid of it, and the lenders is going to take over, and we name it as a distressed properties. So you can have a lot of this opportunities because the syndicator is not going to able to meet with the requirement. It's going to be negative cash flow eventually. So the opportunity is going to come from this point. If you're talking about where is the opportunity going to come from, but about the lenders in general, what we see right now because of the interest rate, we see a lot of change of the rules on the LTV part, or the loan to value part. So all of the indicators on 2023 need to raise more capital, have more equity on their side, because right now we're talking about 60 to 55% LTV, which is dropping from the heaven on 2022 and 21, where some of the deal was 70% LTV. Sometimes like dropping to 65, and some in other cases maybe 75. And what we have right now is the reality is that the lender is not gonna have more than 55% LTV, which is gonna have more implication on the syndicator side to raise more capital, or equity side in general.
Yeah, and it's still fairly early in this. What if you're guessing, right? Because we're not, we can't make that's totally guessing. How long do you think it's going to be until there's really the lot of blood in the water, a lot of the real opportunity is going to come? Is this something that we might see this summer? Or is it something we're going to have to wait till this time next year to really get the great deals, or should we just be jumping at these now? When I started investing in the US, I did it by myself and had to go through the growing pains of doing that. GlennSutherland.com/coaching. A 12-week coaching program done 1 hour per week over Zoom from the comfort of your own home. Classes are kept to 5 people to be able to answer everyone's questions. Shortcut the process. Make fewer mistakes. Curriculum available at GlennSutherland.com/coaching.
Right now, I think the best, in my opinion, a lot of people doing mistakes of saying that I want to jump in right away. And the mistake here is that these things that are different. And I think the best way to deal with the recession is to understand what's happened on the different cycles, especially the 80s and 90s. So in my opinion, all of the matter is what's going to happen on the next 2 raises by the Feds, especially on the February 1st, because all of the indication, as I mentioned, is going to be 25 points. But if it's already 50 base point, I think we're going to have a rough year this year. And just an indication when you have to jump to the market as a passive or active investor, in my opinion, the rule for myself is when you see an actual little bit hike on the price of properties, a 5 or 3% from the last drop. So if, for example, if the prices is going down from 18 million to 17 million to 16 million, and you see a little bit a bump on the price, like 16.2 or 16.5, then you can expect then that we hit the bottom of the market. This is my rule of thumb when you're dealing with recession. But expectation, as I mentioned to you, no one has a crystal ball, even the Feds. If you checked all of the different institution reports, CPRE, all of them saying the same thing. We're waiting for February. We think all of the fundamental is getting better. For example, the prices of different industries, or the price to manufacture in different industries is being shifted to the better way. For example, the price of shipping from China now dropped from 19,000 on top per shipping to almost $1,400 per shipment, which is bringing back to the previous price before the COVID hit. So that's why I think Wall Street betting on that we're going to slow down. The market hopefully is going to slow down and going to the bottom by end of the year. But as this is going to be the case, I think all of what we're going to see is based on February 1st. Additional subject is that we don't see an actual problem on the employment market so far, because the unemployment rate is really good. Okay. It's the lowest on decades. So this is a different, I think, element of not slowing the inflation as the Fed needs. So I think this is a long answer about what's going to happen on 2023.
Awesome. I love this. And as you're underwriting these sort of things, right? Because I've heard about other people they've made mistakes in the past, right? I've heard about people using their CapEx funds, using their renovation budgets to actually pay for renovations, pay for their financing, right? Overages that are happening now. How would your underwriting be different in the future? Would it be like, over raising, or would it be like planning your exit different, or how what's your plan just to make this like a safe investment for other people to jump in on this?
I think the question here, this is a good question, to be honest. Right now, usually when you do underwriting, you're using the last 12 rent rolls, which is a 312 on underwriting the deal. Right now, because the interest rate and the actual market is a moving target, I think all of us now is approaching using the T3 and T6 rent roll, which is the last 3 and 6 months, to have some sort of a better idea to be conservative more when you're dealing with your property, because what happened is from 1 year is not applicable anymore.
No.
Another thing is, as I mentioned, because I think for passive investors, this is a good market to invest. Just a general statement here, because as I mentioned to you, Glenn, on the beginning, that because of what's happening on the recession and the interest rate, the LTVs now became 55 to 50%. So this indicator need to raise more money. And raising more money and having more equity on the deal is better, to be honest, to the passive investor, because it's less risk. You're going to have less risk. You're going to be default on the property for any reason, even if there's a bad performance, God forbid. But this is from the perspective of the passive investor. I think it's better because it's less risk, because the syndicator has to raise more money. About being more conservative, I think, as I mentioned, all of us come to the cap rate, having a constant cash flow for your investors. And this is another subject happened in end of 2022, which is on 2021, you can see easily many deals underwriting, whereas IRR is about 20 and 22%, whereas now we're underwriting on 50% for internal rate of return. And usually we had like, even for the cash flow, like 9 and 10% in some cases. Right now, I think the more valid estimate is going to be on 7% cash on cash, and internal rate of return about 15%. Again, another subject is a capex, especially on demanding markets on like Florida or Texas, whereas the actual, especially if you're talking about asset classes like a B and C, especially the C class in states like Florida or Texas, insurance too. So as a short answer, I think the short answer is going to be the rent roll. The long answer, you have to be more conservative when you're dealing with your passive investor waterfall splits, the returns, and also the price, and always come to the cap rate too.
Awesome. So Adam, this was great stuff. I actually love all of this. I love hearing about. I love everyone's opinion on the recession, because it's great, right? It's there's a lot to learn, and I like to soak as much of it in as I can right now. Before we go, let's talk about your company a little bit, or a little bit about your podcast. Maybe let's bring it in so people understand who you are, because we didn't, you're very humble that you didn't even bring up the podcast right in the intro. So maybe we'll bring up your podcast, and then we'll go into your company, and we'll bring this out.
For sure, thanks. So on 2020 we started our podcast and YouTube podcast about multifamily, especially multifamily commercial spaces. It's named as the greatest multifamily investment advice show. It's a long one. Our focus is mainly on talking about syndication in general, and fund manager, and Wall Street in general. Talking about recessions. And I like the show because we're bringing the value to the listeners about understanding, especially when you're starting on syndication from the passive side, you want to understand how you actually invest professionally. And that's why I like bringing a lot of guests, how to basically explain to newbies about how to invest passively on US, especially. In my opinion, US is the best. I'm a Canadian, but the potential on the US market is really different. And again, I appreciate that you brought the subject of podcast about our company and our team. We started our company last year on syndication in Missouri. Our focus on more in multifamily. We started our deals there on Kansas City and St. Louis. To be honest, we love the Midwest, because the Midwest is provide a lot of good market fundamentals, and it's really good markets. One of them is the population growth, the rent growth. I think one of the main subject about the Midwest is affordability on the US. It's one of the lost markets on the whole US market, is still affordable compared to other markets like Texas, Austin, San Antonio, Houston. All of this good market. I see a lot of potential net migration to the states, but especially we're heading to the recession. A lot of this, in my opinion, this properties is going to have a problem, especially with the new development, because there's no enough demand, especially when we're heading to the recession. That's why we love the Midwest. All of the market fundamentals there, and that's what we are doing now with our company. And this is basically what we're doing now.
Awesome. Yeah, no, as you both, well, for people who don't know, Adam and I have a call every single week, right? So we both love Kansas City. You love St. Louis as well. Lots of fundamentals there, the medical, the transportation. There's lots of things that go through there, right? Being in the middle of the US, right? Another thing about whenever I meet with Adam every week is he's great at suggesting lots of great books. Before we wrap this up, you want to drop a couple hits for some people, maybe some things that they might want to pick up before we let you go.
To be honest, I started the whole thing when I started to read about King of Capital, the rise and fall of the Blackstone, one of the biggest private equity firm on the whole planet. And this was like a changing moment for myself to understanding how actually the business. I'm coming, as I mentioned to you, I'm from the engineering background, and I was thinking that engineering is the best. But I changed my mind, to be honest, after reading how the business work and how this company started to raise millions and millions of dollars based on their experience, and how they provided a lot of values to their passive investors, like bringing 20 to 25% a year as a return. And this is the first book I love. I recommend King of Capital. The second one I think is more about also the private equity firms, about I think it's called
I put you on
Barbarians on the Gates. It's a really old book, again about private equity funds. And the last one was handling objection. And this is mainly, to be honest, for more like active investors, dealing with passive investor objections in general. And if you're in this business, you have to add value, not to sell. And this is the main point for anyone, because if you want to stay on this business, or if you're on the passive side, whoever is talking to you, you have to understand that he's not selling you something. He's providing you with opportunity. He's not selling you something. And this is basically what you have to learn as an active investor, is to not sell. You actually have to provide credibility. You have to provide value. Otherwise, you're not going to stay on this market.
Yeah, I totally agree. Totally agree. My podcast wouldn't have grown if I was just looking to raise money, right? It's about sharing. It's about the community. Adam, before we let you go, is there any contact information or anything you'd like anyone to reach out to you to get a hold of you?
Thanks. For sure. You can find me on our YouTube channel at the Greatest Multifamily Investment Advice Show. You can find me on LinkedIn, and you can shoot me an email at adam.ras@trustcapital.ca.
Awesome. I'll put those couple links in the show notes so people can find it a little easier than having to try and type it all out. But Adam, as always, love getting on the phone with you. Love having a quick chat. And I think that there's a ton of value for people who are listening to this they can take away with. So honestly, I truly appreciate you coming on the show.
Thanks for having me today, and I appreciate your time today.